we've been focused on, and we actually enjoyed that a lot.
Right.
But you're kind of different in that you're helping on the buy side,
Yeah.
not on the sell side.
Yeah, right.
Okay.
Yeah.
And so, I mean, how do you even get started into this thing?
Yeah, I mean, so I guess maybe the way that I got here in the first place, maybe that's interesting to just do a quick note on that. I mean, so I was
Get closer
corporate.
to the camera.
Yeah, I was corporate for a long time,
Right.
for 20 years or so. I went into this world of kind of entrepreneurship and small companies and lower mid-market companies really because I wanted to kind of bring that knowledge of the corporate world, to smaller companies and entrepreneurs and real people that maybe don't have the resources and the background, the knowledge to secure financing, to do deals and grow through acquisition. So, started the company in 2015. So we're almost 8 years in here now. And, there's a lot of education, through, with, bring clients on board. And, Jack, as you and I were talking about earlier, there are a lot of the clients that come to us that have never been through a capital sourcing. They've never been through a buy-side M&A. They need a lot of guidance. They need a lot of hand-holding to make their way through the process. So we spend a lot of time in that onboarding phase to make sure they understand the realities of the situation, right? And we don't want them to think that, they're going to knock down 5 deals in the next 3 months, right? These things take time. It takes time to evaluate opportunities and work your way through them. So, we just try to be very transparent, very honest, and really a true advisor to these groups as they're kind of embarking on what can be a pretty exciting journey for them to grow their company through acquisition.
Yeah. So obviously, there's the organic growth that is ideal, but sometimes there's limits to that, and so companies go and acquire other targets. And correct me if I'm wrong, but where you guys come in is you're helping them both with sourcing of deals,
sure,
and sourcing of funds, financing to go and purchase those companies, right?
Yeah, it can be a couple. Sometimes the clients come to us, they have a very specific target or set of targets in mind, and they want help kind of bringing them on board, and that may be evaluating which ones to bring on board or to pass on. In other cases, they maybe don't have, they have a general idea of what industries or whatever, but they need help in terms of identifying targets. I mean, a good example, I think, we had a client that came to us, last year. It's a pipeline inspection services company. And, they came to us. They actually had a target in mind. It was a division of a large company that was kind of exiting the space. So they had their target identified, but they needed help with valuation. They needed help with the financial due diligence. They needed help with the negotiation process and forming and kind of developing the deal, right? I mean, the seller was very sophisticated. The seller had a lot of people and lawyers and a lot of experience behind them. This was a smaller company, experienced in the industry, but not experienced with acquiring a company. So we helped them through the deal, through the kind of the M&A or kind of forming the deal. Then we transitioned over the next couple of months to helping them secure financing. We secured financing through, in that case, it was an SBA loan. They closed the deal in April. And then now too, part of the value that we bring to our clients is that we're able to help them after the transaction is closed as well. We have, an array of just recurring CFO types of services that we provide to our clients as well. So forecasting, planning, whatever it might be. And so that's kind of a really good illustration of a client that came to us where we're really able to help them through the transaction, securing the capital, and then staying on board with them as an advisor afterwards as well.
Yeah, I want to talk about. Oh, sorry, go ahead, Jack.
Oh, yeah, I was curious. So, with this particular company, tell us a little bit about the first meeting you had with the company, or the first several. What are you trying to unpack in your discussions with this client to figure out how you're going to help them achieve what their goal is?
Yeah, I mean, that's a good question. I mean, the first part of it is, obviously just establishing some trust and understanding. Obviously, that's the first part of it. But then we have to make sure that we can actually help, right? I mean, we're not going to go down the path with someone wasting their time and resources if we don't think that we can help. So the first part of the process is really just discovery, right? We're collecting some information about them, about their company, about the target that they're looking at as well. And evaluating kind of the situation. If there's a capital need, if it's, if they don't have their own capital and they need capital as well, we will kind of vet the opportunity before we engage with the client. We will vet the opportunity with prospective lenders. It might be banks, it might be, family offices or private funds or whatever it may be. And, without providing, specific company information, we'll kind of, put a profile together. We'll float it out there to 3, 5, 10, 15, whatever it may be, different groups to make sure that it looks like something that is going to be workable. If it's not, we'll come back to our, to the company and say, hey, this looks like this might be tough. Let's maybe, revisit here in a few months or 6 months once you guys have kind of shored some things up. And if we have some traction and some interest, then we move forward with them in the process at that point.
And what goes into the profile in terms of, trying to make
Yeah, what do we lose there?
what's the headphones? Like, so what goes into the profile when you're putting
Sure.
this together and you're giving information out to the market, so to speak? What are you helping clients kind of formulate and put into that profile?
Yeah. So, listen, with large companies, the large companies that are looking to secure financing, it's about the company and their financials. And in this, in the smaller space, in the entrepreneurial space, in the lower mid-market space, it's about the company, it's about the target, and it's very much also about the financial profile and experience of the management team and the ownership team as well, right? So that's one of the first questions. Do they have experience in this space? Do they know what they're doing? Have they done acquisitions before? Have they, the lenders or the investors want to know more about the management team and the ownership team every bit as much as they want to know about the numbers and the financials themselves. So it's a combination of building an honest, credible story about and picture really about what the group looks like, what they're trying to do, why they want to do it. Does this make sense for their personal life? And do they live in Florida but they're acquiring some business in Oregon? And how is that going to work, right? So it's about really the totality and of the whole picture, both the financial aspects and the personal aspects and the personal financial aspects too. And that's kind of what we will provide to the lenders or investors to make sure they have a comprehensive view of the opportunity.
Yeah, so I want to get back talking about securing financing. So PPI numbers came up today, in the producer inflation numbers slightly higher this month. Interest rates have been going up, continue to go up, and more than likely is going to stay up here for a while.
Right.
And so we know the 30-year mortgage as a benchmark has been going up, went over 7 the other day. And so the cost of capital keeps going up.
Sure.
And so what kind of an impact is that having on securing financing for these entrepreneurial companies who are looking for financing? And I know, Jack, we've talked about this in the past where PE still has a lot of money to deploy, but maybe some of these deals aren't quite big enough for PE. So they're going to the family offices, they're going to direct lenders, and other sources. What's going on there as far as ability to secure financing these days and the cost of that financing?
Sure. Yeah. Well, the cost has gone up, right? There's no doubt about that. The cost has gone up, 2 or 3 points, depending on, whether it's a safer deal or a riskier deal, certainly 2 to 3 to 4 points in some cases versus where it was, 6 months or a year ago. But there's still a lot of appetite in the small business and that lower mid-market space for deals. Some more traditional, more conservative groups may be kind of stepping back a little bit. Again, I think the larger financial institutions, again, as we were talking earlier, in the M&A side of things too, larger companies can maybe pick their moments when they're doing M&A. Smaller companies kind of take the opportunity when they can. I think it's also, to some extent, the case too with the financial institutions. The large financial institutions maybe seem to be stepping back a little bit, being a little more careful, a little more conservative, because they can kind of pick their moments. But the smaller groups, whether it's private funds or smaller banks or whatever, tend to stay aggressive. They still need deal flow, and so yes, there's maybe a more robust due diligence process. Maybe there's some no's where we had some yeses. but it's a really large world full of investors and lenders, and our ability to, we have established relationships with hundreds and hundreds of groups, and so we can cast the net out pretty widely and pretty quickly, and it only takes one.
Are you noticing any changes to the valuations that you're getting now versus where they were maybe 6 months ago or a year ago, given the higher cost of borrowing?
Yeah, I mean, I think a little bit. I'm not sure if it's I'm not sure if the valuations, if we've seen the valuations change. Obviously, maybe a little bit, but we certainly see more care and more kind of caution in terms of maybe taking on a deal in the first place. So, I mean, the valuations in this space tend to, yeah. I mean, I think so, but I think more so it's about go no go than it is about the valuation itself.
Yeah, I mean, yeah, that's what I've kind of seen. I mean, recently I've seen it's more of a pace. Like before,
Agreed.
the pace was go go go, let's get it done. Now it's like, okay, great, we have an LOI, and then all of a sudden it's just kind of this slower pace of moving, making sure that this is the right deal. The
Yes.
numbers really need to fit, as opposed to before where maybe there was a little leeway to make sure that, so it just, or before, because it just made sense.
Yeah.
Now it's just it's like the string is a little tighter, the budget's a little tighter, and this deal really has to be a right fit. But there is the appetite, if it is the right fit, to pay the price that was being paid before.
Yeah, I think that's exactly right. We've seen exactly that scenario with a multifamily deal that we've been working on. Been securing debt for purchase of a multifamily apartment building property in San Antonio, and yeah, everything seemed like it was going to close in the spring. But exactly like you just said, Jack. Then the borrower the borrower stepped back a little bit, wanted to make sure, the borrower / buyer stepped back, wanted to make sure they were sure about the deal. The lender stepped back a little bit. It's been a much more cautious, careful process. We still think it'll probably close here in the next month or two. But I completely agree with your point. I think it's been much more cautious, maybe than it would have been a year ago.
Yeah. So let's talk about a little bit about process. Okay.
Sure.
So everybody gets excited. They want to, find a deal, close a deal. But, when we're talking about being cautious and crossing the T's and dotting the I's, from a buy side, what does that look like? We talk about buy side due diligence. So somebody comes in and says, hey, I want to purchase this company because there's a good fit, right? We're talking about a strategic buyer here.
Sure.
It's a good fit. I want to roll up my company, and the financials we think look good. What are the steps that you go through, right? Without giving away your secret formula, obviously.
Sure.
But there's some steps that a buyer's got to go through to make sure that, what they're getting out of it is what they think they're getting out of it.
Yeah, no, a good question. I mean, again, there's some quantitative and some qualitative elements to it, like with everything, right? I mean, in terms of, evaluating the numbers, it's, the quality of the earnings, the consistency of the revenues, the extent to which there is or is not, client or customer concentration. These things all certainly are part of the evaluation. Obviously, the earnings growth rate and whether the buyer and seller are close enough in terms of valuation to continue a conversation, that certainly matters. But there's also, even, probably now even more than a year ago, back to what we were talking about just a second ago, there is more caution. And so, there's a lot of evaluation discussion of the management team and who's going to stay on and who's not going to stay on board, and to what extent is the company reliant on those individuals that maybe are leaving, and to what extent, a lot of what if scenarios, a lot of modeling out, what if we lose a couple of key customers, or if projects stretch out over a longer period of time, are we going to be able to kind of bridge that gap and kind of get to the other side? So, I mean, understanding really how the operation works is critically important always, but even more in a market like this, the buyer really has to understand what they're getting into. They have to have, a critical evaluation of what they're seeing and what's being told to them, and to make sure that they're comfortable going forward with the deal, and to make sure they have a little bit of buffer in case things, because there's always some surprises, right? Once you get into things.
Yeah. So on the sell side, we've talked, Jack and I, about how when the market was truly red hot, people just wanting to get deals done, and oftentimes they would bid up prices, knowing full well that they were going to recover the over payment by some kind of either
like indemnity claims,
or some kind of
withholding earnouts, things like that.
Mm-hmm. Sure.
So what are some of the things from the buy side that a buyer needs to be aware of?
I'm sorry. In terms of what, Ava?
So what would happen on the sell side, right, is a company would come in, they have a lot of capital, they want to make a lot of acquisitions.
Sure.
And because it was such a hot market, they would overbid just to get the deal done,
Sure.
knowing full well that they were going to recover some of that overpayment by withholding some funds down the line in,
like making indemnity claims, trying to not find out whatever they can to do to hold back funds or make claims on the escrow, disputing earnouts, things like that, where a seller coming in would say, well, the whole total purchase price is X million, and in reality, you start shaving that away, now it's like 5 million less.
Sure. Yeah. So the question is, on the buy side, so we're going to different lenders, and a lot of times these are not traditional banks, right? We're talking about private funds.
Yep.
And so, they're more complex structures, right? It's not straightforward. And so are there any things, or is there anything that a borrower, in this case, the borrower, has to look out for, that these lenders who are, their investors are saying, hey, deploy the money, that they may do certain things that could potentially come back to and hurt the buyer?
Yeah, I mean, I think that's a good question. I think that there are times it's interesting, because we had a situation earlier this year where I think because the market was kind of tightening up, there was actually a lot of pressure. The lender had a lot of pressure to kind of get some deals kind of wrapped up and closed up. I think maybe before things tightened up further and they started to maybe have the struggle to maybe find good ways to deploy their money. So we had a deal earlier this year where we faced a tremendous amount of time pressure that we would probably not normally, we certainly would not normally have seen, just to get a deal done before the rates were rising again, before that institution maybe had some changes in terms of their underwriting or their due diligence procedures. And so from the buy side, there was a lot of pressure, there was a lot of stress that the lender in that case kind of put on the buyer. And the buyer had to really, kind of go through the crucible a little bit and decide, is this really something that they wanted to do? I think also, to your point, this type of market does kind of breed a lot of creativity in terms of structures, and maybe there are provisions to allow for contingency scenarios. Maybe they want some type, the investor wants some type of kicker. And so the additional, whereas maybe a year or so ago, maybe it would have been a more straightforward deal. The lenders or the investors are wanting to put in maybe provisions to allow for some cushion on the downside, but still trying to capture some upside, which again puts the buyer in a position of having to evaluate a more complex transaction, run modeling to see what will happen in a variety of scenarios, and make sure that across that spectrum of possible scenarios, it still seems like an attractive deal from the buy side as well.
Yeah. That
makes sense.
That makes sense.
Yeah.
Talk about the outsourced CFO services. So a lot of these companies, they might not have the big accounting department, let's say, or the finance department, right? And as they're making acquisitions now, that becomes even more important. So you mentioned you guys stay on board and you help with that transition until they fill in that gap.
Yeah.
We had somebody in here talking about how right now with the job market the way it is, the labor market the way it is, it's kind of really difficult to find somebody, and you're probably paying an arm and a leg. And so outsourcing has become attractive, but that could only go for so long on a temporary basis, right? So
Sure.
what is it that you're able to provide as outsourced CFO work? And what's happening, the second part of that question is, what do you see right now with the labor market the way it is, as these companies are, investing and buying new companies? There's a shortage of labor. How's that impacting these transactions?
Yeah, absolutely. So, I mean, you're right. Our firm covers both these fractional or interim types of roles and also the transactional roles, and they can go in both directions. I mean, I described earlier the pipeline inspection company where we help them with the transaction, and now we're staying on board to help them with their more routine functions. It happens the opposite way as well. We may have clients that come to us that do not have a robust financial team. Maybe they have one person, maybe they have someone, but they're more junior level, and things are it's been fine when they were smaller, but now they're kind of at a pivot point and are dealing with bigger issues and trying to figure out how to grow. And so, we can provide a lot of value to a company like that is needing help with forecasting, needing help with investment modeling to make growth decisions, maybe needing help in terms of evaluating capital options as well. But a lot of times it's about helping to just look down the road and do some forecasting. And it's really, there's so many small companies, even lower mid-market companies, even companies a little larger than that are really have been flying blind. And they do a budget, and they'll look at their historicals, but they've really never done a forecast, right? And they certainly don't do a forecast that's kind of living and where it kind of rolls and is updated every month or every few months or so. And so, I have 3 kids. They're all, they all drive. They're 18 and 21 and 24. And when I was teaching them how to drive, their tendency at first is just to look at the hood ornament, right? Like you're not looking down the road, right? You can't, and when you're looking at the hood ornament, you can't stay inside the lines, and you can't tell if a truck's crossing the line coming at you. And so it's the same concept. You have to look down the road. You have to look past the hood ornament and look out toward the horizon so you can see where you're going and stay inside the lines and take evasive action, right? If you have to. And so just the simple process of putting in place some forecasting and some planning and some analysis and understanding, why you hit the mark for the month or the quarter or why you didn't, and feeding that information back into the next forecast just provides a tremendous amount of value in terms of making quality decisions. That's one. The other thing that having those types of processes and systems and procedures in place provides a ton of value when you're going and presenting yourself to others. So if you're presenting yourself to a bank or an investor or an acquirer, having these systems and processes in place and being able to point to them and having these things kind of built into the company by itself provides a tremendous boost in terms of the perceived valuation and strength of the company as well. So, we have both those situations, but I mean, in a lot of cases, we may be working with a company for months or years or whatever. We're a trusted advisor for them, and now they're ready to grow through acquisition. Now they need capital. And so our ability to kind of cover both sides, both the recurring needs and the planning needs, and then also the transactional needs, I think is a big advantage for our clients in terms of having all of those resources within one advisor.
Yeah, I mean, let's stay on integration a little bit because
Sure.
everybody, everybody is excited about the closing, right? And there's so much emotion, dedication, resources spent on getting to closing. And we get to closing, and now we actually have to make the marriage work.
You're like, oh no.
Yeah, right?
Oh no, it actually happened, right? Yeah.
So, and I find a lot of deals, the deals that kind of don't work well after closing, it's not so much what the text said in the agreement, it's that the integration didn't go well. So can you speak to a little bit about, buyers that go through this process, what kind of outlook or attitude leads to a successful integration versus one that you've seen where just kind of it didn't work out? And sometimes it's just didn't work out, but I'm sure there's different things that a buyer can do to help make sure things go smoothly and you get the outcome you were hoping for.
Yeah, I mean, I think it's like with most things, it's about the people, right? It's about the people in the organization that you're stepping into. It's about the people that are your customers or clients, and having strong communication in every direction as soon as you come on board. The employees can be very very nervous about what their role is going to be going forward. The customers may be nervous. They may have had, kind of a personal connection, to the owner that's leaving, and they may like that person. They don't know if they, how they feel about the owner that's coming in. And so there's just a lot of, I think, people management, and and I think, if the new owner comes in with, a high level of emotional intelligence, and understanding that their employees are probably anxious, that the customers are anxious, and that they really get ahead of those conversations, I think that goes a long way. I had just this conversation maybe 8 or 9 months ago with a client of ours that acquired a company up in the Northeast that was a 100-year-old company, and really old school company, really old school processes. And the company manufactures like flooring and matting for like antique automobiles. Pretty kind of an interesting business. And so he stepped in, and he had a lot of work to do to provide comfort to his new staff and his management team and his customers. And so he and I talked a lot about just being very out front, encouraging conversation. And I think that as much as anything goes a long way to kind of smoothing those things out and giving the new owner the best possible chance of a strong path forward. Right.
I mean, you what I've seen is you really have to hit the ground sprinting.
Absolutely.
Not just running sprinting, because on the sales side, we're trying to not have you fully integrate by the time we're closing, because we're trying to negotiate a deal as a seller, get the best deal possible, and keep leverage to walk away if we don't like the direction it's going. And the more a buyer comes in, gets integrated, starts talking to employees, makes it harder and harder to unravel anything that's happening. As a buyer, integration is key. And a lot of buyers, they want to get in there. They want to integrate right away, even before closing. So when the money moves, they're in a position to have things just go without a hiccup.
Yep.
And so there's a huge tension there, especially as you get closer and closer to closing, farther along in diligence. And depending on the parties and the type of business, you might be a buyer, I've seen, where you really haven't had much of a chance to integrate at all. And you better really have a plan in place for the key employees, for benefit plans, for how you're going to finance the operations and integration right when you close. Otherwise, things can fall apart pretty quickly.
Yeah.
Yeah.
People don't like change. So if you're changing a bunch of processes that may well need to be changed, you have to work with your people to either and they don't know you either, right? You have to establish a lot of confidence and trust right away so that they were on board with you.
Yeah, that selling company might have like the queen or the king of this department or that department, and this is the way we've always done things.
Absolutely.
And as a buyer, you're going in and you see a lot of value in changing that, and that might be a motivating factor behind the acquisition. Is you see the way they've done things, and boy, if I bring in my special secret sauce,
sure,
I mean, we're gonna make a lot of money. And so how do you get that person who's running things to buy in?
Right?
Because you need that person. They have all the institutional knowledge, so you have to get them to buy in and change the way they do things when they're used to being king of the mountain on that issue.
True. Absolutely.
Rob, are there integration specialists that could come in these cases? Because here's what I've seen.
Yeah.
A company will come in, buy another company in the same space, similar company. They're like, hey, we're going to bring in our management team, like you talked about, Jack. But then the CEO's off doing something else. The people that they have on their management team, they're not really integration specialists. They just run the company. And then now there's this conflict. The old seller who agreed to stay on board for a year, they're like, you know what? I don't need this. I'm leaving. The whole thing collapses. So are there resources out there that people could find where they'll help with specifically with this situation, integration?
Yeah. Great point. And we've introduced folks. So if it was kind of financial integration and financial processes, then we will work with our clients on those kind of things. But in a lot of cases, it's operational processes. It's maybe, HR types of issues or whatever it may be, maybe industry specific issues. And so, sure, yeah, there are some great, like outsourced, fractional COOs that can kind of come in and, help for a period of 2 to 3 to 6 to 12 months to kind of get through that period of time. We know a lot of kind of industry consultants that are, specialists in their field. We've worked with a lot of companies in the kind of fitness and wellness space. And so we know a couple of kind of operational consultants that are very focused on the fitness industry. And so as we've had clients that have acquired or built fitness facilities, these types of consultants that have, very specific industry expertise can be a huge resource to help
Okay.
the buyer kind of, yeah.
So then that brings me to the valuation.
Sure.
So we got a target company that we're going to acquire, and let's say we've gone through the valuation, we think it's worth X, but there's integration costs, there's the advisory costs. What are some of these additional costs that need to be taken into consideration as a final number? Because it's not just the number that we agreed on as fair market value of this company.
Yeah, no, I mean, I think there's things and there's things you don't know, right? So you can plan for some of these things, but I think it's also prudent for a buyer to recognize that there are going to be some costs and there are going to be some surprises once they come on board, right? There may be a key customer that just doesn't want to move forward with the new owner. There may be you may lose a key person in your management team, and you may need a couple people, maybe that cost more than that one person who really knew it, really knew the business. So, I think you have to do the very best you can to identify the cost that you really know that you're going to have. Maybe it's equipment, maybe it's software, maybe it's advisors. There's things that you may know that you're going to need in order to kind of roll out your vision for what your the newly acquired company can be, but you also have to provide for for what you're not quite so sure is going to come around the corner as well.
Hidden costs, right? It's like home ownership. I always say whenever there's a contractor involved,
Exactly.
whatever number they give you, add 20%.
Right.
Add 20% to start with.
Right.
More likely you're going to end up with about 30%. So you mentioned you might have a key customer that might not want to be on board with this new integrated company. And so, from the sell side, we always look at, when we're looking at the company, we say, okay, well, if X percentage of our revenue is coming from our top 3 clients, we're going to get this valuation. If we have more spread out risk, we're probably going to get a better valuation.
Yep.
Rule of thumb, and just ballpark.
Sure.
As a buyer, if I'm looking at a target company and I see X percentage of their customers delivering Y percentage of revenues, where am I saying red flag? We don't want to get into this.
Yeah, good point. I mean, and it's kind of a double-edged sword too, right? Because those customers, they're great by definition. They may be the lifeblood of the company, but if you have one customer that represents more than 20 to 25% of your revenue, that's pretty significant. And the loss of that customer, or even the maybe just erosion of that customer in terms of their the revenue that they might be bringing to your company, I think you have to start looking at things at that point. With asset-based lenders, for example, that's that kind of 20 to 30%. That's where the ABL groups start to say, hey, we're gonna have to be careful about kind of customer concentration issues, and I think that's a pretty good number as well for a buyer. It's good to have big customers, right? It's good to have anchor customers. There are advantages to that, but I think if they're more than 20 to 30%, or you just have to start evaluating it more thoroughly.
Yeah, you mentioned ABL. Right. So I want to talk a little bit about when you're taking these deals to market to different lenders.
Sure.
Your understanding of the different products that are offered by these various types of lenders. So we talk about, asset-based lenders, there's the family offices. So obviously there's time and money involved in the cost of going and even having these lenders look at the deal.
Sure.
And so if I'm a buyer and I'm not aware, I might be going to the wrong places and wasting my time and money. So talk a little bit about the different segments. I mean, you mentioned earlier, there's the SBA, there's the ABL lenders, there's the direct lenders, there are, family offices. What are some of the key features, let's say, where these different groups play better than others?
That's great. Yeah, that's a great question. And I'll say too, kind of before I jump into that, for any buyer that is, looking at a target, the sooner we've seen a lot of cases where the buyer kind of wants to get the deal formed and then they want to focus on the financing. That's tough because, you've lost a lot of time at that point, and now you maybe can't get the financing in place in time to actually get the deal done. So I think the first thing I would say is at the same time that you're evaluating the deal and the opportunity and the structure, you also want to start the process of evaluating how you're going to fund it as well. But to answer the question, listen, if you have a $5 million deal or less, and you're willing to do a personal guarantee, and you have reasonable, it doesn't have to be exceptional, but reasonable kind of financial position and financial credit, the SBA programs, usually the SBA 7A program is the most common one, is a great tool. I mean, you don't have to, in conventional lending, non-SBA lending, may get very focused on collateral coverage. And, if you're acquiring a service company, or if you're acquiring a company maybe that is kind of asset light, you may have a lot of problems with trying to do just a conventional non-SBA bank deal because there's not a lot of trucks or heavy equipment or things within the company maybe that are really strong collateral. And if you don't have a lot of personal collateral, real estate or whatever, and there's no real estate in the company that you're acquiring either, that collateral issue can be a big problem. And the SBA, and again, it's not the SBA, and some people do misunderstand this, it's not the SBA that's making the loan. It's banks and non-bank lenders that are working within the SBA program. The SBA provides some subsidy of risk. If there's a default, then the SBA will subsidize 70 to 80% maybe of the loss that the lender suffers. And what it does is makes the lender be much more able to be much more aggressive and take on collateral shortfalls, et cetera. So, for a deal $5 million or less with that profile that I described, the SBA can be a great solution. Now, it does take time. It takes 2 months, 3 months, it might take more. And sometimes the deal maybe needs to close more quickly than that. And so if that's the case, or if you don't want to go through, such a bureaucratic type of process, because it can be that for sure, the private groups can be more flexible. They can be, quicker to respond. They're more accepting of earn-out types of structures. They're more accepting of, seller notes and these kind of things that might be in the background, which are trickier, not impossible, but trickier to deal with the SBA. And so if you need, one of the first conversations we have with any, client of ours that's looking to secure financing is, what is most important to you? Is it most important that we find the lowest cost of capital? Is it most important that we find the highest leverage? Is it most important that we find, the kind of the quickest close or the kind of the most efficient process? And it's really because you usually can't have all three of those things. I think we maybe have talked about this type of thing before, right? You can kind of pick 2 out of 3, but you can't have all 3.
Right.
And so we need to understand what the priorities are so that we can know, is SBA not really an option because we don't have enough time, or is a private lender not the right option because maybe it's going to be a little too expensive? And so, collecting that information, evaluating the profile, and then reaching out to the right types of groups that fit the profile and the interests of the acquirer or the borrower is a hugely important part of the process.
Which one of these groups is the lowest cost in terms of us as a borrower retaining finance counsel to negotiate credit agreements?
Sorry, so I mean, which type of lender is the lowest cost of capital?
Well, not necessarily lowest cost is what they're going to charge in interest, but from our perspective of having our finance attorney negotiate the credit agreement.
Yeah, that's a good question. Honestly, the SBA loans are pretty simple from that perspective because there's not really a lot of negotiation, right? I mean, there's not all SBA deals are equal, but they do have some kind of guardrails and some similarities, and you can't necessarily have your attorney beat up the loan, the loan document, because there are a lot of things that they are in an SBA loan that they just are the way you are, and you either take it or you don't. The private money deals, they can be really simple, and they can be really, really complicated. And so, there's kind of a wide range of possibilities there, to be honest.
Okay. From a compliance perspective, post-transaction, post-financing done, how do the SBA programs compare to the private lenders when it comes to, monthly or quarterly showing of the numbers, and how rigid are they? Where do you have more flexibility?
Yeah, that's a fair point. There is, with the SBA program, there is some, there are requirements in terms of reporting back to you're not reporting to the SBA, you're reporting to your lender. And there may be some covenants in place. But it's pretty manageable. It's not, there's monitoring and there's oversight, but you don't need to, we've never seen a situation where you all of a sudden needed to hire somebody, into your company to handle the SBA, about a monitoring process, right? The private groups and the conventional loans, that again is a wider range of possibilities. Some are very simple and very straightforward and very, maybe just send us your financials, once a year, and others are pretty rigorous. So we've seen situations where, every month or every quarter, there's, tests on liquidity and tests on all sorts of things, and not meeting those, not being within those parameters can lead to a default and accelerated payments or any number of things. So you just get a lot of, there is a lot of bureaucracy, but there also is some simplicity with respect to an SBA loan. A private loan, there's a much wider range of possibilities.
Yeah. So now that we're heading into this economic period where, as you guys said, people are taking their time and looking at the deal, not rushing through. So the deal flow is kind of slowed down, right? So people are being more careful. And you also mentioned where with the smaller entrepreneurial type of companies, they can't really time things. They got to go when it's time to go. Cost of capital is up. Things are slowing down, but you have these folks that if it's time, it's go time. So correct me if I'm wrong, but we might be heading into a time where, as a buyer, I might be able to pick up bargains right now.
Yeah, I think that's a great point.
And so, how do you identify a bargain deal?
Yeah. I mean, sometimes you can identify a bargain just by, you see a seller that is just worn out, right? I mean, you're getting a sense of the seller's motivation and urgency to sell, can be a really critical evaluation by the buyer, right? If person's been grinding it out for 15 or 20 or 30 years, and they're just tired, they've made enough money, and if we had a group a few years ago that was doing a roll up of wireless internet service providers throughout the Southeast and Texas and the Midwest, and they had a lot of their sellers that were just worn out. They've been doing this for a long time. They couldn't really figure out how to scale up. And so, that seller profile is a really significant, I think, aspect in terms of, knowing where you might be able to get a deal. It's probably the thing that jumps out most. I mean, the numbers come into play. Some are just some sellers are just more reasonable. Some understand what their company is and what their company isn't. Some sellers get really, this company is their baby, and they can't see any of the blemishes at all. And so, I probably, as much as anything, it's that psychology and motivation of the seller, as much as anything else that maybe goes into that conversation.
All right. So here's the $1 million question. So I want to purchase this lot up in Driggs, Idaho, on the other side of the Teton Mountains. And I was up there this summer, and I saw what the prices were back then. Right. And I also saw what construction costs were this summer. Fast forward to today, I get emails where prices are being reduced. And I talked to a real estate agent up in Idaho yesterday, and she told me the construction costs have come down from $700 a square foot down to $300 a square foot.
Oh,
Okay.
yeah.
So with real estate, I could watch this and I could see what's happening with prices, and I could now, and I have access to all the properties, right, through the multiple listing service. So I could go and find the deal that works for me. If I'm buying a business, how do I go about finding these deals? Because is there such a thing? I mean, other than obviously you have these businesses that list, but that's not really the kind of businesses we're talking about.
Right.
How do we go about looking at enough deals? I mean, I guess this is a question that PE firms ask all the time, right? They want to get in front of those.
Source, yeah.
How do we source this? But if I'm in a position where I understand, I've got capital ready to go, I have businesses that I'm, the types of businesses, but maybe I haven't identified the companies.
Sure.
Do I just come to you and say, Rob, here's what I'm looking for. Go find me the deals. Is that how it goes?
Yeah, sometimes it is how it goes. And sometimes the entrepreneur, the company has a very specific focus. They know what their targets are. Sometimes they just know their industry and they need help finding companies within that industry. Sometimes they just say, hey, listen, maybe there's an entrepreneur stepping out of the corporate world and I want to be an owner operator. Can you help me find some company to own and operate? And so it can really be all of those, scenarios. And, in terms of how do you source them, listen, sometimes you might be able to find some reasonable opportunities through the listing services. And we have had had the scenario on occasion, but they tend to be picked over and they're not necessarily, they're not the only opportunities that are out there. So from there, a lot of it is about, tapping into your professional relationships, tapping into M&A attorneys, M&A professionals, industry consultants, folks that know about the deal before the deal is really on the market, right? And then the last thing I'll say about that is, it happens in the real estate space where you might get a text message on your phone that you don't want, or a call or message on your phone. Hey, we'll buy your home, right? Do you want to sell? And that approach actually can work in terms of buying operating companies too. If you can kind of define your parameters, maybe geographically, in terms of industry, size of the company, et cetera. There's information. You can identify target companies, and they're not for sale, but you can have advisors, and it's better. And we've had clients that tried to reach out directly to the sellers, and that's a bit of an awkward situation, I think.
Right.
But if you have an advisor that's reaching out saying, hey, we have a client that's interested in a company that's like yours, would you be open to a conversation? Listen, it's not like half the time the owner says sure, but it's more than it happens. And sometimes, yeah, I mean, if you reach out to 10, you might get one or two that say, sure, I'll talk about it. And I didn't really want to go through a formal sale process. So if I have somebody coming to me knocking on the door that wants to buy the company, then that may be a really great invitation for a conversation.
Yeah. What's interesting is, when I get calls, people who want to purchase my practice, the conversation goes something along the lines of, hey, we're calling to see if we could collaborate. And I know that's code. I'm like, come on, right? What, you want to buy?
Right.
And all of a sudden my guards go up, right?
Sure.
And the first question is, okay, do you have money? That's the first question. So going back to what you said is have that financing in place, have the capital in place, because you might stumble onto that somebody who's just had it. They're ready to retire.
Absolutely.
They're ready to, move on, do other things. So Jack and I talk about the fourth quarter being where a lot of transactions happen because everybody wants it done before the end of the year. And then once we get to Thanksgiving, pretty much it's done, right? Is there a season if you're a buyer, like, when if you're buying a car, they tell you come towards the end of the month where they got to hit their quotas. Yeah. Are there better times of the year where people could pick up, do better deals than other times? Or
yeah, that's interesting. I think things or everything just happens, in slow motion during the summertime. So if you're trying to get something done quickly, that's not the time to do it. In terms of, I think there's two. Do you want to get the deal done quickly, or are you looking for a good deal? And I think those are two different questions. If you want to get the deal done quickly, probably, you start looking around, August, September, because everybody wants to get it done before year end. But I think the first quarter of the year, is also a really good time to kind of take on those initiatives, right? I mean, buyers and sellers are maybe, they've kind of had some reflection on what happened the year before. They may have been thinking about, okay, this is time for a change or a tradition, some kind of transition. And so I think early in the year it can be a great time to look for some opportunities and maybe get some better deals and some more cooperative sellers where there's maybe not quite as much, there's not as many buyers that are maybe hunting in that first part of the year, and that may be a good time to do it.
Yeah. And so,
Okay, go ahead.
no, I was going to say, so maybe reality is going to start setting in here as the economy continues down this path that we're in, with higher interest rates, things slowing down, and maybe we're going to get back to more normalized valuations here. And so opportunities abound here in 2023.
Yeah. Yeah. I mean, I think one comment, I think that, you mentioned a minute ago, Avo, that, having a pool of capital available to take advantage of an opportunity is a tremendously great strategy. We have a prospective client in Florida that's doing a roll up, and he wants a line of credit so that he can, an asset-based line of credit in his case, so he just has a pool of funds there that he can deploy when he sees a great opportunity. And I think on a similar point, as we're kind of going into kind of uncertain economy and shoring up your access to capital, now's the time to do it, right? I mean, getting capital when you don't have to have it is so much easier than securing capital when you're desperate for it. And so, I was reading an article about this, yesterday or the day before, as we can see that next year might be a little dicey, and so to secure financing now, line of credit, maybe extending your line of credit, maybe, bringing in investors or whatever it may be, now is a great time to do it so that you provide some buffer, and have a pool of funds there to help you get through maybe a rough patch or to take advantage of an opportunity that may present itself.
Yeah. When you need the money, banks don't want to give you money. And when you don't need the money, every single bank wants to give you money.
Right.
That's just the way it works.
That's right. Exactly right.
One more question, I think, in terms of negotiating a deal and trying to get to the signed LOI phase. And that involves kind of the point where, we have a buyer who's identified a seller, looks like a great fit. Seller agrees. We're trying to get on a price. And there's still some distance. What tools are out there to help bridge that gap? Ones that come to my mind are usually like earnouts.
Yeah.
What have you seen, or what situations do you see where maybe an earnout is appropriate or a seller note is appropriate, where we have a good deal in place, or we see that seems like a good deal, but we just need to somehow bridge the gap.
Bridge the gap. Yeah. Well, I think you hit on kind of a key point. If there is just a disconnect between, sometimes sellers they get caught up in wanting to be paid for what the company might be in the future, or but there's so much potential, and after you take it over, the company's going to be worth so much more. But the buyer is paying for what the company is now, not for what the company used to be, not for what the company is going to be 3 to 5 years from now. So sometimes you do get that conversation it's a common conversation between a seller that sees potential but still wants out. And so the earnout is obviously a great tool where you have metrics with respect to revenue or number of customers or new customers or profit levels or whatever it may be. And so that's certainly a great tool. Seller notes are a good tool as well for that type of scenario. Seller notes also serve well to cover if there's maybe a collateral gap, if there's financing that's coming in with the buyer, and there's not enough collateral within the company to support the financing. having the seller note there is a great tool to be able to kind of bridge that gap there as well. But there's as many structures out there and as many solutions out there as anyone can kind of think of and devise,
Mm-hmm.
right? And so yes, you have an honest conversation, and I always kind of coach, we coach our clients too to say, listen, of course you want to get a good deal, right? Of course you want, but at the same time, if you go into the negotiation trying to squeeze every little bit out of it, and you're not being at all considerate of the other side, the seller on the other side of the table, and there's not give and take, and then that's not a good way to approach the transaction. And on the other hand, if you can go into the negotiations and have an honest conversation, kind of a spirit of hey, let's work to get this done. Let's figure out where the points are where we can kind of agree where are we going to have some trouble. Kind of identify those issues and have an honest conversation so that it can be a win-win scenario. That really is the best way to kind of make these things happen. So you can be creative with structures, you can be creative with financing, but all in all, you still want to come to the table with a sense of honesty and candor and appreciation for the person on the other side of the transaction as well.
Right, and this is where I think also advisors play a key role, not in just the coaching and understanding. Look, I mean, it's establishing trust, understanding what the realm of a fair deal is all important. But it's also, how are you going to message things? In certain situations, you'll have one party that's maybe very agreeable and says yes through every conversation, and then they come talk to me, and it's like, well, we can't do all that, or it's not working for these reasons. So having, a situation where you're having these open dialogues and having advisors involved in the right process is going to help things move more efficiently versus, the iron fist approach or the very agreeable approach. There is a middle ground, and having good advisors to tell you where that usually is helps kind of set the stage to making sure things go smoothly.
Yeah, and it maybe takes some of the emotion out of the conversation sometimes too, which can, the buyer and seller may start butting heads, and if there's advisors on both sides, then that can help to smooth, kind of grease the wheels and make things happen. And each can be advised on which fights to pick and which fights to to let go. Right.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.